Michael, good to get back, my friend.
Thanks for having me.
It's been quite a tumultuous time since we both first spoke. I know we've spoken again, I think at the crypto gathering, but on the platform, we haven't spoken for a long time. And that kind of interview changed a lot of people's lives, I think.
Yeah, it was an interesting time then. Yeah, what was Bitcoin, like 15,000 or something? It was like in the teens then.
Yeah.
And that was before we started to see all of the advances and the buys by the other companies.
So what I'd love to dig in to start with, since then, what are your learnings? What have you learned about the whole space? Because as we all know, this is a kind of hugely evolving situation and we kind of are figuring things out as we go. So what didn't you know then that you kind of know now?
Well, I think in every month for the past 13 months, there have been positive developments that give us more confidence in Bitcoin. The result of the election was a positive development. The regulatory regime, I think, is a positive development. I think we had 0 public companies holding Bitcoin before MicroStrategy, and now there's like 25 maybe. By the end of this year, we'll have about a dozen Bitcoin miners that have come public. And if you look at the success of the miners like Marathon and Riot, and I think I just read a few days ago that Hut 8 is doing a secondary offering. You've got SPACs in the work from TerraWolf. You've got Core Scientific coming public. You've had Coinbase come public, right? Since we last spoke, you've seen Coinbase not just come public in a $1 billion IPO. Coinbase also brought a $1 billion convertible offering to the market. And then just a couple of days ago, they brought a $1.5 billion junk bond offering to the market. And they upsized it to $2 billion. And they raised that money at 3.5%, a blended rate of 3.5% interest. So, what I've said from the beginning is it's important that we carve a channel between the ocean of traditional assets and the crypto pond, right? And the ocean of traditional assets is $100 trillion worth of debt, which is yielding nothing on a real basis. And it's whatever, 50 trillion, $80 trillion worth of global equity. And it's hundreds of trillions of dollars worth of commercial property and residential property. And it's $80 trillion worth of cash and cash equivalents and things like that. And the key to carving that channel is the public markets. And so in a world where there are no publicly traded companies, no listed registered companies that can actually cross the chasm, then the flow of capital into the entire industry is just retail. And what we've seen is a rotation, right? If you'd ask who's driving the industry a year ago, you would have said retail investors with 10, 20, 30, 125x leverage on an offshore exchange. And if you'd ask the question, who's driving the industry today? Well, it's a hodgepodge of a lot of different players. You've still got, the offshore exchanges, but now they've allowed that they will back down to 20x leverage, to be more conservative. So there's no doubt that offshore crypto leverage money is in the system. I think it drives volatility,
sure,
in my opinion, more than it drives sustainability. If you want to see Bitcoin go to $10 million a coin, then it won't come from 125x or 20x offshore levered contracts and traders. It will come from insurance companies and macro hedge funds that have capital, $100 billion of capital, and they just allocate 5% of it to Bitcoin forever. And when you start getting 5% allocations forever, then you'll start to build a monetary base and a capital base that'll drive the industry. So I think in general, the bullish developments of the past 12 months have been institutional adoption of Bitcoin, and that has come in the form of the companies, the Squares, the Teslas, the MicroStrategies, the Marathons, the Riots of the world that are actually in the space. I think that the second thing that I've been a big proponent of, a big cheerleader of, is if you're going to be in the Bitcoin mining business, then you're naturally long Bitcoin. And if you're naturally long Bitcoin, it's inconsistent to ever sell it. So if you're a Bitcoin miner and Bitcoin goes to zero, your business is worth zero. And if Bitcoin goes up and you sold your Bitcoin, your business is worth 20% of what it would have been worth. So if you really are a Bitcoin miner, you're long Bitcoin, which means you hodl all the Bitcoin. And so at this point, I think you see an emerging consensus in the past 12 months that if you're a Bitcoin miner, you should never sell it. Okay, now that's only consistent with the idea of Bitcoin miners all coming public in the North American markets. If you're a Chinese Bitcoin miner, you didn't have the capital markets to not sell it. You have to dump it on the market, right?
Yeah.
And the narrative was always, oh, the miners are dumping, they have to sell their Bitcoin, right? Watch the miners. And if you're a Bitcoin miner, Raoul, in Europe, or if you were trading on the Canadian Stock Exchange or the European Stock Exchange, if you dig a little bit deeper, you'll find that those companies had a liquidity of like $2 million a day. $1 million of trading a day, 5 million a day on a good day. If you look at the liquidity in Marathon and Riot, 400 million a day, 250 million a day.
Incredible.
Okay, so wake up call. You move from a cash business to a small to the secondary public markets, to the primary public markets. When you move to the primary public markets, let's take MicroStrategy. MicroStrategy had a full market capitalization of $1 billion before in August of last year, with 500 million in cash. And we've had days where we traded $1 billion worth of equity. Now we have 500 million in liquidity a day. Okay, so what is that telling you? Right, the answer is as the companies in the space come public and as they migrate to the capital markets with the greatest amount of capital, if you can raise equity capital, at a high multiple, that's cheap capital. If you can raise convertible debt, since we talked, MicroStrategy did a $650 million debt offering and paid 75 basis points, but then we followed up with a $1.05 billion debt offering and paid zero interest. And then we followed up with a senior debt offering and we paid 6 1/8 interest on just junk debt. There's nobody in the space that thinks that Bitcoin isn't going up 6% a year.
No.
Nobody. So the issue is, do you know how much how much capital I've invested in Bitcoin at this point, Raoul?
No.
$3,335 million.
That's pretty spectacular.
So one person.
Yeah.
But I didn't have $3,335 million in my piggy bank when we last spoke.
Yeah.
Now, what happens if more than one person does this, Raoul? How many people does it take, right? And the answer is you need public entities, and they need to be creditworthy, and they need to be able to file a registration statement. If you can file a registration statement, you can tap the fixed income markets, you can tap the convertible debt markets, you can tap the equity markets. And as you do that, that capital becomes permanent capital, right? Because, by the way, there are some companies that can't own digital property. They can't own the underlying property that is Bitcoin. Like if I have $10 billion in a fixed income fund, it took me 30 years to establish my relationships with my limited partners. I've got a charter. I have a charge. I can go and buy fixed income. Right now, my fixed income instruments are yielding 2% or 2.5% or 3%. Or I can buy MicroStrategy yielding 6%. It looks like a pretty fat coupon to me. Well, we had lots of firms that gave us $50 million orders after one conference call, Raoul. We did that entire deal in one day. No one-on-ones, one conference call, 130 firms on the phone. Okay, I'll give you a $50 million order. I'll give you a $25 million order. I'll give you a $100 million order. And why do they do that? Well, I mean, you get the Moody's credit rating, you get the S&P credit rating, you're a public company, you package a security, right, a derivative of a crypto asset called Bitcoin. It's a Bitcoin bond. And you put it out there and they can buy that thing. So what we've seen over the past 12 months is we've seen the creation of public securities. A lot of people can buy, $500 million worth of Marathon stock or $100 million worth of a Bitcoin mining stock, but they can't buy the Bitcoin.
Yeah.
They can buy the convert, they can buy the equity, they can buy the junk debt, but they can't buy the Bitcoin. And of course, people in the crypto industry, the crypto traders, they don't understand why, right? Like, there's still a group of people that think, oh, well, you need to buy it and put it in cold storage and keep your keys, which is, what would I call it? An ideologically pure approach to the industry, which works for a subset of people. But when I'm talking to a guy that runs a $2 billion portfolio, if he went to his boss and said, I want to buy $25 million worth of Bitcoin and hold my private keys, he would get, between laughed and fired, right? Like, that's not happening in 1,000 years, no matter how hard. On the other hand, the guy can go like, okay, so yeah, this is good. So what was the interest rate again? 6%? Okay, I'll take 25 million of that. Next. He's got another deal to do the next day. So I think that what we're seeing is the maturing of the industry, the maturing of the asset class. When JP Morgan and Morgan Stanley started offering Bitcoin funds, like the NYDIG-backed funds and the Galaxy-backed funds, that was a big endorsement, a big step forward. And I think we got Wells Fargo, we've got Morgan Stanley, we've got JP Morgan. They've all moved to offer those funds. That was a big deal. And then I think that when the ETF comes, right now we've got ETFs in Canada, right? I don't know if you saw, Fidelity just went before the SEC. This is Fidelity. This is Fidelity for the last 60 years. They have like $10 trillion of assets under management. And there are companies that have been doing business with them for 50 years or 30 years. Fidelity goes in front of the SEC and they give a 20-page presentation on why Bitcoin is mature and why it's time to approve a Bitcoin ETP in the United States. And there's a lot of institutions that they will take $10 million chunks and $50 million chunks of this stuff once there is an ETP of sorts. And roll the clock back 18 months, none of this.
The other thing that you have championed is talking to the corporates. And it's not been as easy as we thought, because of accounting rules. Talk people through a bit about that learning, because you've spoken to a ton, you've helped them, you've given them all of the information that they could possibly need, but it's still a slow process, right?
To be clear, I think there are two structural catalysts that will drive an acceleration of the industry and of Bitcoin in particular. One will be the availability of broad-based ETPs in the U.S. capital markets. Yeah. That will be a big one. And we're watching that right now. It's a process. The second will be the normalization of accounting for Bitcoin as a financial asset. Right now, Bitcoin is an indefinite intangible asset. When we roll the clock back 24 months, you couldn't find a publicly traded company that had $2 million of this stuff on their balance sheet. So if you're a bunch of accountants sitting around analyzing it, you would say there's no compelling need, right, to normalize this. No one's got $100 million of this stuff, right? There's $100 trillion of credit instruments, and there's $2 million of Bitcoin. So I don't think we're going to focus on this. And I understand that. But indefinite intangible accounting treatment says you can mark it down, and you have to mark it down to the lowest bid you can find on the exchange at any minute of the day since the beginning of when you own the asset, and you can never mark it up again. So that's a negative, right? It's a one-way ratchet function, but it's worse than a one-way ratchet function. It's like I bought a collection of baseball cards for $1 million, and I have to go to everybody I see at a party for the rest of my life and ask them if they'll buy my baseball card collection for a number. And if they tell me they'll give me $1,000, I have to mark the baseball card collection down from $1 million to $1,000.
Ludicrous.
And if someone else, if Bill Gates offers me $1 billion for the baseball card collection, I'm still carrying it on my books as $1,000. So it's prejudicial, hostile, accounting treatment. And that, of course, is suboptimal. But there's another suboptimal thing about it, which is when you do mark it down, you have to run it through your P&L as an operating loss. It's not even a below the line, it's a non-cash, it's a non-cash investment cost in theory, but not per indefinite intangible. Per indefinite intangible, if Facebook buys 50 billion of Bitcoin and it trades down 10% and then it trades up 100%, instead of holding $100 billion of assets, they're showing 40. And then in the next, quarter, they have a $10 billion operating loss against their $10 billion, gain. So they make no money in the year, even though they made $50 billion in the year. Okay, so what does that mean? Well, look, if you're a pure play like MicroStrategy and your investors understand we have 114,000 Bitcoin, you ignore all the rest, you multiply 114,000 by 47,000 and change. You're like, oh, they have $5.5 billion worth of Bitcoin. Okay, and if it doubles, they'll have 11 billion. And you divide the number of shares into that, and you come to a conclusion about what you think the company's worth. Okay, that's one approach. But if you're running Apple Computer or Facebook or Google, and you've got a pristine P&L, and you've got a pristine balance sheet, and if you're a conventional CFO, you would think, well, like I have a perfect P&L and a perfect balance sheet, and if I put this on the balance sheet, it's going to obscure the P&L, and I'm going to create pro formas, and it's going to obscure the balance sheet, and now it's another set of pro formas. And now I'm going to go from telling everyone that I made 37 billion last year with 120 billion in assets to something hyper complicated that takes a half an hour to parse. And most of them are conventional, traditional investors. They don't want to spend the time on it. So the Warren Buffetts of the world, by the way, like he's totally fine owning Apple stock and Coke stock on his P&L, but he marks it to market every quarter. Right? Whereas in this particular case, Bitcoin critics, you never hear a critic say, I spent 100 hours studying this and let me break down my 13 concerns. And you never hear a critic say, I spent 1,000 hours studying all this and I took the course and I read all the books and I listened to what Raoul said. I listened to what Saylor said. And here's my 92-point rebuttal. You never hear that. What you hear is somebody asked me what I thought, and I didn't really know much. So I said, well, I don't understand it. Tulips. I don't, whatever. Quick response. So uninformed pushback. Now, investors normally take the path of least resistance. So I think the current indefinite intangible accounting treatment is an overhang. If Bitcoin would go, it'll probably go to 500,000 regardless. But if you wanted to go to 5 million a coin or 10 million a coin, right? The way you get to millions of dollars of Bitcoin is you start to market and you treat it at least at parity with holding Apple stock or Coca-Cola stock. And I think that consensus is building in the marketplace. even amongst, if you look right now what's going on, we have briefed the regulators, right, multiple times. We've gone in front of FASB. I think 18 different entities have gone in front of FASB. This has become an issue. They're in a review process right now. They've actually asking for comment from the community. I think I'll probably tweet something out on that in the next couple of days, if not in the next day or two, asking people to opine. And I think they've received briefings from institutional investors, from corporations, from other accounting firms, the like. And I'm confident at some point they'll normalize it as a financial asset. I can't tell you whether it's a this year thing or in 2 years or 3 years, but that there's no real compelling reason to treat it worse than you would treat baseball. If I bought baseball cards, Raoul, it would be better accounting treatment. if I just went and I bought like a bunch of artwork and Picassos at an auction, it would be better accounting treatment than buying Bitcoin. So irony is when the actual is the opposite of the literal. And in actuality, Bitcoin is more transparent, right, as collateral, as you've said, than blocks of stock. And certainly it's a lot more transparent than a lot of other illiquid assets, like buying timberland or a building or the like. So at some point, I think people will start to realize that there's a rational way to account for it on a P&L, on a balance sheet. And at the end of the period, you probably should market to market. And if you're up, it's an investment gain. And if you're down, it's an investment loss.
Yeah, and you've been championing this by just using the word property more, trying to anchor people on thinking of it as a digital property. Is that what you're trying to do there, to get people to start thinking of it in those terms?
I think that there's three metaphors for Bitcoin, and I think one metaphor is digital property. We're demonetizing the monetary premium in your commercial real estate, your residential real estate, your gold, your silver, your commodities. There's a lot of things that have been monetized, right? I mean, in Canada, they've got the current example where the prime minister thinks the foreigners have monetized all the houses in Canada, so they cost so much that nobody can afford a house. So in the monetary inflationary regime that we've seen for the past who knows how many years, you've seen monetary premiums flow to all sorts of other properties. It's pretty obvious. People monetize Da Vinci's and Picasso's, right? Like artwork has become monetary instruments as well. And the problem with monetizing things with utility value is if I monetize houses in Tokyo, no mere mortal can ever afford to buy a house in Tokyo. And that happened back in the 90s, right? Starting in 1990, the Bank of Japan pumped so much money in the economy that Tokyo real estate was obscene. The same thing happened in New York City where, $10 million will buy you 4,000 square foot apartment. Well, how does somebody making $300,000 a year or $100,000 a year live, right? You've monetized that asset. So there's a problem with monetizing those things. The ideal thing to monetize is an instrument that has no utility value, which is what Bitcoin is. So digital property is the ideal property. It's the most desirable property in space and time. Bitcoin is the dominant digital property network. It's the most secure. It has the most durability. It's the most decentralized. So therefore, if you said to me, where do I put my $1 billion such that any rich person on earth will want it and any rich person in the next 100 years will want it? Bitcoin. If you buy $1 billion of buildings in New York City, billionaires in Beijing can't use them. And when the mayor of New York City enjoins you or impairs you from evicting your tenants or taxes your building, you can't pick it up and move it to Monaco or Singapore. So $1 billion of property in New York or $1 billion of land in Kansas or $1 billion of houses in Vancouver don't represent as high a quality property as $1 billion of virtual Bitcoin, because Bitcoin can be moved at the speed of light anywhere on Earth. That's the first check. The second check is if you have to hold it 100 years, a building doesn't have a 100-year lifespan. The Rockefeller Center, or another way to say it, it's got a maintenance charge. You have to reinvest 3 to 5% a year every year for 100 years in order to maintain a building. And even if you do that, name one building in New York City that's 150 years old that's commercially viable today. The useful life of a building, not that great. How about the land underneath the building? Better. Buy blocks of New York City, and that'll be good for a while, but you've got a property tax on it. The property tax, and you've got the risk of seizure by eminent domain. So, and you've got the meddling of the neighborhood zoning board. They can zone your 10 blocks to be low density.
Yeah.
Or they can zone it to be high density, and high density makes it worth $50 million a block, and low density makes it worth $1 million a block. So imagine having the neighborhood, the mayor, the governor, every regulator in the United States, the White House, and Congress all deciding whether or not they will impair your asset or your property every year for the next 100 years. That's the problem with all these properties.
But could they impair Bitcoin the same way to give it a carry cost? So there's a holding tax that you have to pay every year of 3% in line with property. I mean, that's likely to happen right over time.
The basic principle is this, Raoul. Bitcoin is the apex property of the human race. It's the hardest to impair. Yeah. It's the hardest to seize. It's the hardest to tax. It's the easiest to move. It's the easiest to keep confidential. You can subdivide it. Take your 10 acres of property in New York City, or your 10 city blocks in New York City, divide it into 97,000 pieces, and then rent it out to 97,000 people that live somewhere outside of New York City every hour. You understand where I'm getting, which is I can oscillate the property at 60 megahertz. I can move it at any frequency. I can subdivide it, in any partition. And if New York wanted to tax it, I can move it to Wyoming or Florida. You see? Yeah, certainly the politicians are going to attack stuff with tax. When you have $1 billion of property in Beverly Hills, and when the governor of California decides to tax it, how are you going to move that to Miami Beach?
You can't.
Right. So my point is not that there won't be taxes and there won't be attempts to tax it. But let's come back to the theory of like stolen cars. A car thief can steal any car. So why do you bother to lock your door? You lock your door because you figure you might as well make your car just like 37 seconds more difficult to steal than the car in front of you or behind you. So they'll steal that car. And I think if you come back to Bitcoin as digital property, you can move it, unlike land. Yeah. How do you move the domicile of Apple headquarters? You've seen the Apple headquarters. That's not moving, right? So you can't move the domicile of a corporation. You can't move a factory. You can't move land in Kansas. You can't move a city block in New York. You can't move the Rockefeller Center. Okay, can you move $1 billion of gold? Theoretically, but practically no, right? It would take you 6 months. Try smuggling $1 billion worth of gold through the airport. Think it's not easy, maybe in theory, but they can pass a law making it difficult to move the gold. Can you move $1 billion worth of artwork? Well, sort of, but you're dependent upon Sotheby's and Christie's to value the artwork, and it's kind of esoteric. You might get the Crown Prince to buy your artwork, but there are a lot of people in the world that don't really need your artwork. Try subdividing a Picasso by 97,000 into 97,000 pieces, lending it out on the weekend, and then combining again on Monday morning. Not going to happen. So, Bitcoin, I can move it. It's hard to confiscate. It's hard to tax. But let's say, Raoul, let's come back to this tax issue. I'm an American citizen, and no state's going to get it. No municipality is going to be able to tax it. Miami taxes my property 2%, or Florida does. I can't move my house, but I can move my Bitcoin out of Florida. But let's say that, you're really focused, right? And Congress passes a law saying every American must pay 2% a year to own Bitcoin.
Wealth tax, yeah.
Okay. Let's get to the extreme. Well, they're going to tax everything else first, right? That wealth tax they've already basically put a property tax on every piece of property in every state in the country. So eventually, let's say they get to that point. And let's say that they combine that with you have to give up your passport, pay an exit tax, and live out of the country for a decade before you can duck that. Okay, fair enough. Right? That was, you kind of got me there. But having said it, I can sell the property. Okay, so if I hold Bitcoin in the U.S. as a U.S. citizen at 2% a year for 50 years, okay, I'm going to pay 100% of the asset value of the Bitcoin. Having said all that, there's a person in Singapore that still will want to own $1 billion of Bitcoin. Sell your $1 billion building in Manhattan to the person in Singapore when they put a 2% tax on the building in Manhattan. The point is, you don't have the option to sell it. It's not going to be that useful. And then let's come back to the other point, which is Bitcoin. You could think of it as digital property, but you can also think of it as digital energy. Mm-hmm. And if you think of it as digital energy, right? All energy becomes matter. All matter can become energy. There's conservation of them. You can neither create nor destroy that, right? I can take money, $1 billion of money, turn it into $1 billion of energy, turn it into $1 billion of products and services, turn it into $1 billion of property. All of these things are fungible in a socioeconomic system. If Bitcoin is digital energy, then what's special about it is, let's take let's take a megawatt of power. If I have a megawatt of power and I sell it on a commercial grid at 11 cents a kilowatt hour, it works out to be about $1 million. That's what it's worth. Store a megawatt of power for 100 years. Can't do it.
No.
Okay, you lose 2% of the energy in the best battery every month. So your half-life of electrical energy is 3 years. You can't store it. Can you move it? 6% is the transaction fee to move it 500 miles. And you need a line, build a power line, move it 500 miles, pay 6% each time. Move it 10 times. Okay, pay 60%. Move it to Tokyo. Can't do it. Store it for 100 years. Can't do it. What happens if I mine Bitcoin, take an S19 miner, put it on a megawatt of power, convert it to Bitcoin? I've converted electrical energy into digital energy. It's worth $4 million of Bitcoin on an S19 miner. An S19 miner will spit out about $1 million worth of Bitcoin. Now, what happens after I've digitized the energy? It'll last forever. Can I move $4 million worth of Bitcoin, move it to Tokyo? Well, 2 days ago, someone moved $2 billion of Bitcoin for 78 cents, Raoul. 78 cents to move $2 billion of digital energy anywhere on Earth. People are like, well, it's slow. Well, it takes an hour or half an hour on the main chain.
That's hardly slow.
Okay, try moving $1 billion of gold or $1 billion of electricity 10,000 miles. Yeah, okay, build yourself the pipeline to move $1 billion of natural gas 10,000 miles. Can't move it at all. Chemical energy doesn't move. We had contango in the oil market when petroleum prices went negative. Why? Because you can't store oil, right? Store $1 billion of oil as an individual. Can't do it. You can store $1 billion of Bitcoin on an Android phone that costs $50. You can move it at the speed of light. They're discovering that in El Salvador right now via the Lightning Network. We're now moving digital energy at the speed of light at a transaction cost of 1 Satoshi. 1/2000th of a cent is the price. Now, it's a big idea, but here's the idea. Humanity has advanced via harnessing chemical energy, wind energy, right? Potential energy, hydro energy, thermal energy, electrical energy, nuclear energy, and what's the end of it? Digital energy. If you convert those forms of energy into digital energy, that energy has three properties that are critical, and people don't get this. The first property is the digital energy has a half-life of forever. I can hold it for 100 years, right? The second property is digital energy can be moved at anywhere on Earth for free, teleported. That's a big idea. The third idea is you can subdivide and oscillate the energy, any frequency at any scale. So what do I mean by that? Or I'll give you an illustration. I have $50 million and I buy a hotel in Dallas, Texas, and it's got 100 hotel rooms. Now, I want to generate yield on the hotel. So I let people book the rooms, whatever the prevailing rate is, $100 a night. The average utilization in Dallas, Texas is going to be like 62%. And my fixed costs are such that I get about a 10% margin. And if we fall below 62%, I'm losing money. I'm not getting any yield in that. Okay, that's physical property. Now convert that to energy, pure energy. I buy Bitcoin. It's a energy hotel. What does that mean? Well, now I can actually move the hotel or take the rooms of the hotel that where there's no demand in Dallas, Texas, and I can send them somewhere else in space to get to 100% utilization. And when I get to 100% utilization, obviously my profitability jumps from 10% to 60%. My yield goes through the roof. Now, having said all that, if every single room in the hotel was booked every single day, then obviously the hotel is generating higher yield. But even if I booked every room in the hotel every day, people are only using 8 to 10 hours a day of the rooms. What if I could subdivide the hotel down into room hours? And if I could reclaim the 62% of the room hours when the hotel is still idle? Now that's interesting. Now I get to 300% utilization. Now here's a bigger idea. 300% utilization at $100 a room night turns my profitability from 10% to 200%. What if I could actually sell room hours anywhere on Earth and I could go chase after the highest marginal value of the room hour? So during the Super Bowl, I put the hotel where the Super Bowl is. And during the Venice Film Festival, I move it to where the Venice Film Festival is. And if there's an inaugural event in DC, I move the hotel there. And then I could double the room rate to $20, or $200 a day instead of $100 a day. What I have done is I've vibrated the energy, or I've moved the energy at a higher frequency, and I've captured a higher marginal utility. And I've done it by dematerializing the property to pure energy on a network. And I kind of just described the promise of DeFi, which could be CeFi or DeFi, but this idea of dematerialized finance.
But it's also the collateral thing that I've been talking about, because basically what you've got is a piece of collateral that somebody's going to want at some point. And therefore you can charge accordingly for your collateral, which you don't do with treasuries because yields actually go down when everybody wants collateral. It's kind of weird. But here you're getting the piece of collateral that somebody wants. So if somebody's in financial stress, they need something, they need the collateral, you can lend it out instantaneously anywhere in the world. And the collateral's never impaired because it's on the blockchain. It's a really fascinating concept.
It's like Tesla's concept of understand frequency. Understand frequency. And what does that mean? High frequency, high fidelity collateral, or high frequency, high fidelity energy. In this particular case, if I have $1 billion of gold, I put it in a vault. What's the monetary velocity on that? Once every decade?
Yeah.
Yeah. I can't divide the gold into 1 million pieces and lend it every hour. The velocity, the best way to get velocity on gold is coin it, right? If I converted the gold into coinage and we're trading the coins, I can kind of move to a higher velocity money. Bullion is low velocity money. If I go to the fiat system with credit cards, $1 billion spent via the credit card system, it takes 30 to 60 days to settle. Right? When I give you $1,000, you have to wait 30 days before you know that the credit card company is not going to claw back the money.
Yeah.
So it's a little bit tricky as a retailer. There's a 2.5% fee every single time it changes hands, and the velocity is 5 per year. Okay. Now let's go to digital energy and the entire crypto space. You see what's going on. The velocity, the final settlement is in an hour. Well, what if the final settlement's in a second? Well, let's just keep it at an hour. Final settlement's in an hour. There's 8,700 hours in a year. So now I take my $1 billion block of energy and I subdivide it 1,000 ways and I move it back and forth every hour and I chase after the person willing to give me the highest marginal yield on the energy. And how do you do that? Well, one computer talks to 100,000 other computers 1,000 times a second, or 1,000,000 times a second while you're sleeping. And what you have is a financial system that's continually yield seeking, looking for someone that needs that loan. Maybe it's a loan for a month. It's, and you're either borrowing or you're lending, one or the other, right? I mean, I can lend it and generate yield off it, or I'm borrowing. I'm seeking the person willing to give me the lowest cost loan. If you have a certain amount of Bitcoin, let's say I have $1 million and I expect it to appreciate at 10% a year. If my expense ratio is less than my appreciation rate, I can borrow against it forever with my loan to value falling, right? My debt to equity ratio will keep falling. I can spend 5% of my money every year forever, as long as it appreciates at 6% a year, assuming I've got a bank that I trust, right? An effective banking system. So I think that this idea of digital energy is a very important one. It's an important one because it makes it the most disruptive force in the entire energy industry, right? You're converting every form of energy into digital energy, and the world's full of stranded energy. What's the problem with energy? You can't store it, right? You can't store chemical energy in the form of oil. You can't store it. You can't store wind energy. You can't store solar energy. You ever seen a solar energy battery array? Like I've seen them. I saw someone with solar power and with windmills sitting on an island in the Bahamas. And I looked at the battery array. The battery array takes up a warehouse, and you walk into it. It's all rusting. It's all going to rust within 5 years. It's a nightmare to store renewable energy, anywhere where there happens to be water vapor, and the cost is obscene. So every single form of energy, you can't store it. 1/3 of it is wasted. And so converting energy into digital energy is critical because you move it anywhere at the speed of light, it lasts forever, and you can oscillate it at any frequency, at any scale. And that means harness the value of it to a degree that is inconceivable before. The digital energy is also interesting, of course, to any investor. It changes banking, right? It totally changed the way you think about banking and finance and yield. And of course, think about a world, Raoul, where everybody's taking their excess money and they're buying. The conventional store of value for middle-class citizen is, I buy a rental home. I had a guy that worked for me, he quits my employ so he can buy 3 rental homes, rental properties, and he rents them out. Okay, well, that's fine. But on the other hand, if you had $500,000 and your choice is, I'm going to have physical property in a domicile or a jurisdiction that can be impaired by circumstance, acts of God, acts of politician. It's like how you rent something in Eastern Virginia during a drought.
And also, anybody's ever done that trade, and we've all done it. We've all bought places to rent out. It's a fucking nightmare. The actual effort you need to do to rent something out versus owning an asset like Bitcoin, where you virtually have no effort. the difference is extraordinary.
Bitcoin's not going to spring a leak. There's not going to be a property tax. You don't have a maintenance charge. It doesn't spring a leak. It doesn't burn down. There is no eminent domain.
You don't have to evict your tenants. Nothing.
Yeah, all sorts of things like that. It's unique, Raoul, in this respect. Property is superior to a security for so many different reasons. If you own property from a custodianship point of view, it's superior to a security. There's no way that a mayor, a senator, a congressperson is going to stand up in front of Congress and say, my Apple stock is a superior store of value to the US dollar. You can't do it. It violates every ethics rule, right? If it doesn't violate a whole host of laws, it violates ethics rules. Plus, when you're promoting a security, you're taking counterparty risk, right? You're dependent upon the acts of the board, the acts of the CEO. You've got the domicile. Gary Gensler's on television today talking about how the Chinese don't allow us to audit Chinese auditors, and maybe you can't trust a company in China. There's all sorts of issues with the security. So name me the properties. I got gold. Gold's got no velocity. I got timberland. Okay, so the average person, how do you buy $10 million of timberland and harvest timberland? I got natural gas rights. That's great, but if there's no pipeline going to natural gas, how do you sell your natural gas? Right? I got Picasso's. Oh yeah, that's not a manipulated market, right? Art, right? Like, it's a very esoteric market. How many people can buy $37,000 or $37 worth of like rare art? Silver? Diamonds? Okay, what's the property that I can trust, right? And the answer is Bitcoin, because it is truly decentralized and it is homogeneous, and yet it has been anointed as property. It's a safe haven. The IRS says it's property. The SEC says it's property. And I'll make one last point, Raoul. It's fungible property across time and space. For example, 1 Bitcoin equals 1 Bitcoin today. And if I decompose it to 100 Bitcoin, 1 million Satoshis and put it back together again, I've still got the same thing. And at the same time, 1 Bitcoin in 10 years is going to be 1 Bitcoin. It's going to be the same quality. It's going to be 1/21 millionth of all the monetary energy in the network forever. That's not the same with your house. If you bought a lake house and on Lake Tahoe, to Airbnb it out, in a decade, it may not be as high a quality as today. You have to invest huge amounts of maintenance to maintain as new. Even if you do that, it's still going to be dated in 30 years. There's no way to avoid the property. Maybe you bought the most beautiful lake house in Lake Tahoe, and in 30 years, someone builds a condo next to it because some politician rezoned the land to your left and your right. And nobody wants to stay in your lake house if it didn't sink into the water, if something else didn't happen, even if you're the perfect landlord. And so this idea that I can have a pure, pristine property in time and space that I can decompose and recompose, that I can oscillate, that I can program, this is unique in the history of the world. There's nothing comparable to this. And we have not developed this. This is property that anybody with a computer can develop. I can write a computer program to move this stuff around. Some kid in Zimbabwe can write a computer program on an Android phone that can create value from your digital energy or your digital property. They're not going to develop real estate in New York City. Nobody, and your timberland in wherever it is, Montana, is not going to get developed by some intelligent hacker in Singapore. So you're tapping into something which is incredibly powerful, inconceivable before now. Most people still they don't have their hands around it. Digital energy is the technical metaphor that says this is the technical imperative for Facebook and Google and Apple and everybody with a computer, programming capability or a CPU chip. Digital property is a macroeconomic metaphor. $100 trillion is going to flow out of real property to digital property. Digital money, that's the political metaphor. Digital money is the most controversial. I prefer to stay away from it.
Don't use the term money. It's much easier.
It torques off all the politicians and all the mainstream and everybody that doesn't understand it. And they just get all worried, it's going to topple the government or it's going to undermine the status quo. So if you leave that and you say it's digital energy, it's just energy with a half-life of 1 million years that you can oscillate at 60 megahertz on a mobile phone for 8 billion people. It's digital property. It means every middle-class person can store their life savings in property and get yield on it from the highest bidder everywhere in the world every second of the day, and they don't have to stress out about the property burning down. When you understand those two things, you step back and you say, what am I going to do? And the answer is, I'm just going to own it. Just going to own it, man. Just buy it and let everybody else figure the stuff out. 100,000 entities are going to come up with a way to utilize digital energy or develop digital property. Just own it.
Yeah, and because network adoption, it'll just keep working. It's magic. So here's another thing I want to think through, because I don't really know the answer to this. Humans are humans, and we're going to create leverage. And we talked about the monetization or the financialization of assets. And we see it at retail levels. You talked about this 20x, 100x. But we're going to see it at scale again, because that's what humans do. Is that going to change some of the properties of what this looks like in the future? Are we going to introduce some of the risks and some of the downside that it's not really there in this marketplace now?
No, I think that the number one critique right now of Bitcoin is it's volatile. But I don't think it's volatile because it's digital property, digital energy, or because of all of the constructive uses of it. I think it's volatile because there's too much leverage in the offshore crypto exchanges and the altcoins. I think that what's happening is someone buys an altcoin with a 10x lever, it moves up 20%. They cross-collateralize into the second altcoin, and then they somehow collateralize that or they tie that into Bitcoin. I think that 20x and 100x leverage in the offshore crypto exchanges has been driving the volatility in Bitcoin. And I think that as we come off of that, I think that we're not going to see 20x leverage. Coinbase doesn't offer 20x leverage.
No, but the investment banks will, because they can't help themselves, because that's where they see money is, I'm going to give somebody else, a bigger financial player, a hedge fund, for example, this kind of leverage.
Well, I mean, like we just saw the equity swap issue with Archegos play out. But I can tell you that I've traded with all the wirehouses for 30 years with hundreds of millions of dollars. They never offered me an equity swap. Okay, it's not very common to be able to get an equity swap, even if you have a $500 million portfolio. So 99%, maybe 99, everybody I know, they're not trading with equity swaps. The highest amount of equity or the highest amount of leverage you see in conventional markets is like 50% or 2x leverage. And so I'm not really concerned about that. The future of Bitcoin is transitioning into the public markets and the institutional investment markets where the leverage is normally going to be 2x or less. And I think that it'll be delevered more than it'll be levered. I think that if you look at the velocity of the crypto markets, people are taking 10x and 20x trades, and those things are being marked to market every minute of the day on the weekend with forced liquidations. The reason you get volatility is when you put 10x or 20x through something that's got. If I have a $2 billion market cap and $30 million of this stuff is trading, and I lean on it with 20x leverage against something else, then I'll move that number. If I'm cross-collateralized and I'm able to go back and plug that into Bitcoin, you'll actually drive some Bitcoin volatility. But, the volatility is coming from the crypto markets. It's not coming from conventional users of digital property or traditional institutions.
And also what's very different about this market is if you take leverage in the New York Stock Exchange or the futures market, you have margin. Somebody calls you up and says you need to pledge more capital. The crypto markets are the opposite. It's like, we control your margin, we'll liquidate you immediately. You get no choice. So you kind of know what you can lose. In futures markets, you don't know what you can lose, because in the end, if you can't pay your collateral the next day, your margin the next day, you're in shit street.
Yeah, I think the conclusion is, look, if you look at where Gensler is going, and where the regulators are going, they're going to regulate the stable coins. They're going to regulate the DeFi exchanges like Uniswap. They're going to put more regulation on the offshore crypto exchanges. They're going to put more regulation on the onshore exchanges. And as they do that, one of the consequences is leverage is going to get taken out of the system. The obscene amounts of leverage comes from, DeFi combined with offshore 20x, right? And if you go onshore, it's kind of hard to generate a 200x leverage play. In fact,
Impossible,
as I said before. So you remember what happened when BitMEX went offline?
Yeah.
When they brought charge against I was trading in the market, Raoul, and so like looking at it every minute of the day, like I very, very trading in it, like having the skin flayed off your back if you saw something go wrong. Like I watched Bitcoin go from 9,500 a coin to 10,500 a coin in 3 minutes, like while I'm on the phone. And then I went to bed and I was short. I was trying to buy it at 9,500. I was short and I went to bed, and it came back to me by 3 p.m. the next day. But I damn near had a heart attack, right? Like literal heart attack. When BitMEX went offline, I watched half the velocity disappear. Sorry, half the volatility disappeared. Like you could literally see, like the volume got cut in half and the volatility came way in. And so I think that you're seeing progressive waves of normalization as these markets get less levered, and I think that that's going to continue over time. I don't know that it will end tomorrow, but obviously my long-term thesis is you look out 2, 3, 4, 5 years, as more and more large institutions hold this with less and less leverage, the volatility on Bitcoin decreases.
Yeah, and as network effects take hold and more people own it, becomes less volatile, just because the nature of the number of people buying and selling each day just lowers that over time. So here's a final question I want to think about is, okay, let's go out 10 years now and just think about, okay, there's this kind of digital asset world with DeFi and everything else. Where's Bitcoin's role in that as the apex predator? What does that mean? Does it mean all DeFi is on Bitcoin, or it's a broadly spread digital asset world with this new technology and Bitcoin is the kind of base layer collateral of the entire thing? How do you think about that?
I think that Bitcoin is the most decentralized digital property, right? It's the highest quality digital property. We want to create a digital property running on a decentralized network that's owned by everyone and no one. Right? That's the real key. It can't pass the Howey test. We can't have, no one can shut it down. You can't have people upgrading it every quarter or every 6 months. You can't have a CEO of it. You can't have a CTO of it. You can't, you need to have something completely decentralized. Once you've got that, now the velocity of the digital property, and again, when you call it digital energy, you start to see it differently. You realize you can accelerate it on layer 2 platforms, and there are a lot of decentralized layer 2 platforms. So Lightning is a decentralized layer 2 platform. You could say that many of the other cryptos, to the extent that they're decentralized, they're layer 2 platforms, right? there's going to be a battle to see which cryptos are truly property versus which ones are security. And Gensler has said that on no less than 4 different occasions. He thinks many of these cryptos are security. So as we start to see more guidance there, he's also said some tokens are commodities. So as we sort out which token is commodity and which token is a security, you're going to have a competition of layer 2 tokens. The Lightning Network runs on a layer 2 on a token which is Bitcoin, right? Which is an interesting thing, but I think that you're going to see a competition there, and then you're going to see layer 3s. And layer 3s I define as CeFi, centralized finance applications like Square or PayPal or Coinbase or Binance, right? All of those are moving large sums of Bitcoin at high velocity. You know, Square's got 30 or 40 million customers, and you can move any amount of Bitcoin from Square Cash Tag to Square Cash Tag instantly for free. So as you start to see those, they're going to create an accelerated finance. Between you and me, I'm not sure that decentralized finance needs a decentralized layer 2. It needs a decentralized layer 1. Like, you need digital energy to exist in order to move it at the speed of light 100,000 times an hour across 100 jurisdictions in order to do yield farming. So you need digital energy, and Bitcoin is. You need 1. Do you need 2? Not necessarily. You need 1 digital token that you can move at the speed of light 1 million times a second. If I've got that, JP Morgan can get in this space. Coinbase can get in this space. Square can get in this space. Square's a bank. You know, like there's this Coinbase wants to have a lend product that has yield. The SEC says that's a security. They can't offer it. Okay, well, they didn't say you can't offer it. They said you actually have to register it under the SEC 40 Act. There are plenty of organizations that offer money market funds with yield. You're either a bank and you offer a savings account with yield and you subject yourself to banking regulation, or you're issuing a security and then you have to file that with the SEC. You're running a fund, you know, and the NYDIGs of the world and the Fidelities of the world, they're filing their funds, you know, with the SEC, and they're getting SEC authorization for that. So I think that there's going to be a massive competition, and there's a market competition. Will centralized regulated entities in the U.S. that have gotten certified funds approved by the SEC, will they create that opportunity? Will Square and PayPal with mobile apps, will they do it on a mobile app? They probably also need to get SEC approval to offer it as a mobile app, right? Just because you have a mobile app doesn't mean you don't have to, you know, you saw Abra has this issue where they have to get approval from the New Jersey authority to offer a yield product on a mobile app. So you're going to have the technology players wanting to get into space, call it fintech. You're going to have traditional players like Fidelity wanting to get into space through traditional funds. You're going to have these interesting Lightning-based things that want, you know, there's non-custodial wallets in Lightning like Moon and Breeze. Then there's custodial wallets like Shivo, right? And Shivo's got, you know, can Shivo move Bitcoin around with a banking license? Sure they can. Why? Because El Salvador made Bitcoin legal tender, you know, so that's why they can. Then you're going to have the crypto space, you know, with Ethereum and Cardano and, you know, and Binance Smart Chain and Solana and all the rest competing. And you're going to have all sorts of issues of competition versus, you know, technology versus regulation. And then you're going to have jurisdiction. And, you know, Binance and FTX are offering very innovative products, but they're not offering them in the U.S. So what will happen? And the answer is stay tuned. I just watched yesterday a senator, Toomey, ask Gary Gensler, can you please, is a stable coin a security? And Gensler said, it well may be. He didn't say it was. He didn't say it wasn't. He said maybe. And Toomey said, well, it doesn't seem like it to me. And, because I'm not pursuing profit. Of course, in Gensler's response might very well be, yeah, but people on the other side of the trade, the people that issued the stable coin, are trying to borrow $60 billion at zero interest and lend it out at 60 basis points. They're pursuing a profit. This is why it's an unregistered money market fund, and you got to come and register with us. So they went back and forth, and at the end of the day, Toomey said, you need to give me clarity. Okay, instead of actually regulation by enforcement, why don't you actually publish something? Okay, and Gensler is kind of saying, I hear you. Now what's going to happen? I think we can expect over the next 12 months, you're actually going to see more guidelines about this. But it's pretty clear to me in the last 12 weeks that if you really want to win the DeFi space in the next decade, I think the winners, Raoul, are going to be the publicly traded institutions that know how to navigate the corridors of power, right? That the ones that, if you can take your company public and you can raise $10 billion via a registration statement, then I think you're going to be a big advantage. I think that Fidelity issuing an ETF is going to be a big advantage if they get their ETF approved. I think the NYDIG is going to have a big advantage. I think that people that are trying to operate outside of that system, if you can't tap into the public markets, I don't know if you noticed, I just sold nearly $400 million worth of equity into the public market via registered ATM. And then I converted into Bitcoin. And I did that in 3 weeks. Okay, so in 4 weeks, not that much effort, I put $400 million into this ecosystem. And you know how long it took me to gather the first $400 million? 30 years. 30 years of 2,000 people going through millions and millions of transactions to get the first 400 million. Few weeks, couple of people get the next 400 million. Why? Because we're publicly traded, because we follow the registration statement, because we can tap the capital markets. Gensler says this to the Senate yesterday, I quote, if it stays outside of the public policy framework for AML, tax compliance, and investor protection, it is not going to long persist, unquote. I think that's pretty clear what he's trying to tell you.
The issue I've got with all of this is I get the AML, I get the tax stuff. It's this stupid securities law from 1933, 1934 that doesn't make sense. It makes it highly restrictive in who is able to access certain things. It's that what is a security is we're trying to fit something into a wrong framework.
Yeah, Raoul, I mean, that's what the crypto guys would say.
Because anybody can buy a house. If you say it's a property, everybody should be able to buy it.
Yeah, but Raoul, if I created my own Mikey coin and then I pumped it on Twitter and I dumped it on the retail population after I gave a bunch to a celebrity who then told the world it was great, it's illegal and it's unethical. The truth of the matter is if you have a centralized group of people creating a token, which is a security, giving it to themselves and then selling it on the market and representing it as a decentralized property, you're crossing an ethical line and you're also crossing a legal line, and you can't avoid the ethical responsibility and the legal responsibility simply by saying, oh, it's new tech.
Nobody's saying that. What I'm saying is to classify it as a security is not the right way of stopping that. It doesn't stop it in equity markets. It doesn't stop it in the VC markets. It doesn't stop it at all. What it is it makes it more restrictive for people. Now, that nefarious behavior needs to be regulated.
If you understand securities law, you understand that they are securities. If I actually create 10 million tokens and I give 5 million to me and my 4 my four compatriots, and then we start marketing the rest, and we do it without a registration statement, without disclosing who owns the security. It is a security. You are violating securities law. The law is black and white. And so the only people that think it's not a security are people that don't know the law, right? If you look at everybody in the crypto space outside of Bitcoin, I think that most of them have never taken a company public. They don't have general counsels, right? They don't understand securities law as it stands. Like, I can't go, it would be inappropriate and unethical and illegal for me to go and give 1 million shares of MicroStrategy to a quarterback and then have him stand up and say, MicroStrategy coin is the future on Twitter, right? The whole point of securities laws is I have to disclose that via an 8K. There's all sorts of obligations, and the reason why is because I've diluted every other security holder, and that guy's making a representation that is closeted in another situation. So you really have to have a grasp of securities law here, and the person who's actually most informed on securities law, who is also most informed on crypto, is Gary Gensler. He actually knows more about cryptos than just about anybody I know in the crypto space. And he also knows more about securities and commodities law than anybody in the crypto space. And he has said on no less than 4 occasions, I quote, "There are a small number of cryptos that are not securities, but very many of them are," unquote. Right? You couldn't be clearer than that.
What does that mean? So let's say that you have to register, right? Like everybody else does with a share offering. What is the issue?
It means that you literally have to register who owns the stuff.
But what's wrong with that?
Well, there's nothing wrong with it. That's the ethical, legal way to do it. The point is, that's not what's happening right now, Raoul.
No, and that changes. Fine. The point being is I just think it's the wrong discussion because it doesn't matter. So let's say they regulate. So we all have to do it like Real Vision does or MicroStrategies does. We all have to register. Everything gets put down. There's a certain framework that is not based, that has an understanding of what digital assets are, and that people to operate or offer these things have to go through some regulatory framework. I mean, that's normal, right?
Well, what you're missing, Raoul, is that if they're securities and you have to register them, then it's either unethical or illegal for most political jurisdictions and most people to own them or trade them. What happens is, like, for example, it's illegal for a congressperson to promote a security. It's unethical. So what you're going to find is that a lot of the crypto industry structures simplify in a rapid fashion, and you don't really need that many, right? You need very few. You don't need the 10,000. You probably need the one.
No, that's right. You certainly don't need people promoting it in the way that it's done, because it is not right. And that all of this stuff needs to get cleaned up in certain ways, without question.
I think the bottom line is there's a lot of regulatory cleanup to be done, and as it happens, you're going to see a shakeout in the crypto industry. Raoul, a year ago, I told you sell your gold, buy Bitcoin. I don't think I was wrong. Today, I would say sell your altcoins and buy Bitcoin. The conclusion is you should sell the altcoins. Everybody is overestimating the potential of the altcoins, and they're underestimating the potential of Bitcoin. The value of true digital property that is decentralized, that is a commodity, that is within the regulatory framework, is huge and underestimated. And over and over again, what the regulators are telling you, like these are direct quotes from Gensler yesterday. Stable coins may well be securities. Some tokens are commodities. Many of them are securities. DeFi is decentralized in name only. There are 6,000 projects. While some of these are commodities, many of them are securities under the law, and many of the platforms are. That's what he's saying. He said it 4 times. And he's not wrong, by the way. He's not wrong.
But Michael, making it a security doesn't make it illegal. You just need to register. And if you register, you can do as you wish within the securities laws. So it doesn't actually make a difference. It's not like, oh, everything's illegal. It's like, no, you need to register it as a security and operate within guidelines of the administration that you're in.
Yeah, the point is all the exchanges where these things are trading are not registered with the SEC, and the DeFi exchanges are not registered with the SEC. So the only way they avoid complying with SEC laws is by maintaining that they're commodities as opposed to securities. And as soon as they're deemed as securities, that means that the DeFi exchanges have to shut down, right? And the tokens have to stop trading because they can't meet the requirements of AML, KYC, or they're trading with excessive leverage, or they're trading without the registration statement. So that the entire industry shakes out in a huge way. And it's to the benefit of the traditional institutional investors to the detriment of the crypto entrepreneurs. The people that are going to be the big winners are going to be the ones that have the publicly traded traditional financial fintech companies, because they can harness this. The ones that are going to suffer from the liability are the ones that are attempting to create their own coins and their own exchanges without filing with the SEC.
Yeah. And let's see. I think people will just file. Once they give guidelines, people should file. And then it's sorted out. And then things survive or they don't survive. I mean, it's as simple as that.
So if they do file, then that means your 20x, your 100x leverage that went to 20x leverage now has to go to 2x leverage.
Good. I mean, good. I mean,
you understand where we're headed.
Yeah, I personally don't use leverage, and I wouldn't.
Which means that the industry matures and it stabilizes, and the volatility decreases, the confidence increases, but the competitive edge of some people in the crypto space, right, is offering that much leverage. And if you didn't have that competitive edge, if you can't offer that range of coins or that range of leverage or the ability to do it without AML KYC, then you're at a competitive disadvantage. You lose market share. So where's the market share going to go? Right? It goes to other players that maybe have bigger brands or have conventional assets. Right? If I have 1 billion people on my iPhone, then maybe I can grab the entire space. So I think we're going through this period, and the question is going to be how many years will it take before that shakeout? And can you normalize yourself, right? I mean, the crypto exchanges are moving to normalize in regulatory jurisdictions. It's pretty clear that you're not going to be able to say, I have no headquarters, right? And therefore I'm not going to file. So, I mean, if you boil it down, I just think the upside on Bitcoin is underappreciated, and the upside on the other cryptos is overappreciated. I think the opportunity here is go long on Bitcoin. Bitcoin is a solution to every tech company and every finance company in the world. And the fact that it's decentralized property and is deemed as a commodity means it is the innovation. Everything else is speculation, and it's dangerous speculation.
Yeah. I mean, if you're referring to Bitcoin as the base layer, which I believe in, then that is exactly the case. And everything else is a risk curve. There is nothing else is the same as Bitcoin. And anybody who claims that it is lying. So you have to realize that everything else is risk curve. And risk curves operate in financial markets, always have done. People want to take more risk, and risk comes with downside, or it can come with upside.
I think that you could think of it as this: the layer one, the core monetary asset is Bitcoin. It's decentralized property, decentralized energy, and a commodity. The layer twos, there's going to be a lot of maneuvering there as to whether or not the layer twos are Lightning or whether the layer twos are another crypto network that's permissioned or not. And there's going to be continual jockeying back and forth because of the AML KYC issues around them. Can you construct a decentralized exchange and, that doesn't implement AML KYC that will still be deemed as acceptable, and that's going to be a bit controversial. And the layer threes are going to be the NYDIGs and the PayPals and the Squares of the world and the Coinbases and the Binances and the FTXs of the world. And the question is going to be what jurisdictions will they operate on and what range of products and services will they offer, right? Fidelity's been fairly conservative. Binance has been very aggressive. And then you've got, and Coinbase is not nearly as aggressive as Binance or FTX. But even so, Coinbase is, if you actually listen to that testimony, Gensler said Coinbase has not registered with us, even though they have dozens of tokens that may be securities, right? So from his point of view, I think he would like to see more registration from even the onshore exchanges. Coinbase does a great job of AML KYC, and a lot of tokens have been unlisted, right? Delisted from Coinbase.
Yeah.
Did you see how Uniswap delisted 100 tokens?
Did they? Don't follow it.
Yeah, about a month ago. And there's a SEC action with regard to Uniswap. I think that if you're an institutional investor and you just want to make an investment and sleep well at night and hold it for a decade or 100 years, then you buy Bitcoin. If you're a crypto venture capitalist and if you're looking for fast 100x returns and you're willing to break all this down, maybe you go into these other spaces. But I think you have to study and parse every word that goes on between the regulators and Congress. And if you're going to be in crypto ventures, you really need to be tracking very carefully the evolving regulatory, opinions of every jurisdiction, from China to Europe to EU to, Singapore to whatever. And you have a lot more anxiety. There's a lot more risk, and maybe there's upside. I mean, you talk about risk curve. You're on a risk curve.
Yeah, you are. And maybe there's catastrophic risk in that as well. I mean, I'm not a big player of that alt space outside of ETH, really. But I'm interested in it just because I'd like to see how it develops, because it's just very interesting times. Now, use cases that get developed on one protocol can end up on another. A lot of things can end up on the Bitcoin protocol, and that's interesting.
I think that the technical opportunity is digital finance, and digital finance means I want to move my money at the speed of light 1 million times a second to the highest bidding counterparty with security, right, with trust. And so you can achieve that a number of different ways. I don't think that the old line traditional finance companies will get there very soon, right? My money would be probably on a crypto-friendly exchange that managed the regulatory issues with it, with a degree of deftness, right? I mean, the highest velocity is sitting in the crypto exchanges, but they've just got to work through the legal issue. If they can work through the regulatory issues, like KYC and AML and what tokens they can list and not list and whether or not they're allowed to give yield products or not, then I think they win. Otherwise, then it comes down to just a matter of marketing. Like if Apple were to get into the business and offer, Bitcoin on Apple Pay or something like that, or Google, they've just got these massive marketing machines, or Facebook. So the big guns haven't really entered the space.
No, but they're coming.
The mid guns, right? Square and PayPal are having some success. I mean, 2/3 of Square's revenue is Bitcoin. So you could make the argument, who's created the most value? Well, Coinbase has got a $50-60 billion market cap, but Square's got a $125 billion market cap. Or is it PayPal that's sitting on a $330 billion market cap, up $100 billion, and somewhat materially fueled by Bitcoin exposure and crypto exposure? So I think those are interesting places to watch. But I would say anybody that's going to be a crypto investor probably ought to parse every single word coming out of Congress, the Senate, and the regulators.
Because change is coming.
They matter. And I don't think they mattered as much for the last 4 years. I think the market was dominated from 2016 to 2020 by the offshore leveraged exchanges, and it was the Wild West. And I think that 2020 to 2024, this is the institutionalization. The good news is there is broad consensus that this is technology that's critical to the future of the economy. And you have a lot of senators, Senator Toomey, Senator Lummis, a lot of politicians, a congressional caucus, and you even have a lot of regulators, including Gensler himself, saying, look, Satoshi's innovation is real. He said it on the record, right? The subtext of everything, by the way, Raoul, is that the regulators are not questioning whether Bitcoin is commodity. That's the story, right? If there's one story. So there is a lot of broad-based support for digital property and for decentralized property, and it's clear it's here to stay, at least in the Western world. The Chinese aren't quite so clear on it. In places where people don't like property rights, like Cuba or North Korea, who knows what they'll do. But in the Western world where property rights are respected, this is just digital property. And the consensus is, if you disclose it, if you let us know, if you pay your taxes on the capital gains when you get capital gains, and if you abide by AML KYC procedures, then it's good property and it's an alternative to real property or security or anything else. So that's the good news. But the real uncertainty is, how is every regulatory jurisdiction going to normalize this, and then how are they going to treat all the other tokens? And nobody knows.
No,
nobody knows, but everybody's talking about it.
Yeah, it's going to be very interesting. I mean, the EU as well. I mean, there's a whole lot of stuff. So as you say, regulation is going to be a feature of our lives. I know that the space originally thought that could get around regulation, but it's not going to. It can't do.
Well, let me come back to one last point, which is everybody's caught up in the sound and fury in this. The sound and the fury and the noise, and they're sifting through 6,000 altcoins and trying to figure out the future of this and that and the other. And then the one big trade is right in front of your face, which is Bitcoin's going up 130% a year every year for a decade. Bitcoin is up much more than that this year. The cost of capital, if you're issuing expensive junk debt, is 6 1/8% interest. The cost of capital for Coinbase is 3.375% interest. The average person's cost of capital on a mortgage against their house is 2.5% interest. There's tons of money. You can borrow money at 5%. You can loan it out at 100%. Right? If the only trade you do is you buy $1 billion of Bitcoin with debt or equity or whatever and sit there and wait, it's a pretty good trade. And it's you don't need to take all these other risks. It's like people ask me, are you lending out your Bitcoin? Are you trying to get yield? I'm like, well, we're getting 130% yield on average for a decade, but we got 250% or whatever. Why would I risk losing it all for 5% more?
I mean, I'm the same. I don't do any of that because it's a risk that I can't quantify and it's unnecessary.
Buy a high quality property and wait. And I would say take all that energy. All these companies jumping through hoops, juggling razor blades to figure out how to do something complicated. Something simple is just take your $1 billion of cash and credit and convert it to Bitcoin. All the balance sheets of the world, all the balance sheets of every company, they're sitting on cash and credit that's crumbling, right? It's not even debated. Everybody knows the debt is losing purchasing power. Everybody knows the cash is losing purchasing power. And every one of these companies has the ability to borrow money or raise capital, at obscene rates, right? You're raising capital at revenue multiples that are obscene, and you're borrowing money at interest rates that are lifetime low. So there's plenty of capital. There's one obvious trade. Just convert crumbling cash and crumbling credit into digital energy, into pure property, which is not debasing or degrading. It's that simple. It's a simple idea. It's almost too simple. So everybody has to look for the second derivative, the third derivative, some complicated idea. And I guess where I come back on is like, I'd rather spend 1,000 hours figuring out how to borrow the next $1 billion and buy Bitcoin than spend 1,000 hours creating a software company to do something complicated with Bitcoin, or to spend 1,000 hours looking for the next Bitcoin. It's like, why don't you just borrow $1 billion at 0% interest and buy it and wait? Because Satoshi's innovation is real. It's that simple. Because people think the trade's going to run out. Well, not till we get to like $200 trillion, it's not going to run out. No. I mean, we're $1 trillion now of market cap. So you've got a 100x turn on that.
Yeah, to my point.
And 99% of the marketplace hasn't taken that trade.
No.
And why is that? It's like, there's no ETF, so I can't punch a button. It takes 6 months to figure out how to buy the naked asset. So make it easier. And the other reason they haven't taken that trade is gap accounting, accounting optics. Okay, and people say, well, are you bothered by that? And I think, actually, I'm not bothered by that. I mean, the truth of the matter is, at MicroStrategy, the longer it is that people are afraid of the accounting, the longer we have as the exclusive, publicly traded buyer of Bitcoin. If everybody else is afraid of indefinite intangible accounting and I'm not afraid of it, then I get an exclusive on buying the stuff. And I guess it's going up at 200% a year. I don't think I want it to go up any faster. If it went up 1,000%, I mean, didn't you lose the opportunity to buy? So
yeah,
I'm not bothered by the FUD. I describe it as like the shock wave. It's so disruptive that everyone's got to have an opinion on it. And so they're forced to have an opinion without spending 100 hours or 1,000 hours to understand it. So that's the shock wave on one side. I'm not bothered by the accounting because it's just optics. And making billions of dollars while you take a non-cash charge of something which you can look through is actually kind of a differentiator for a company. If you're not afraid to go through that, then you've got a unique value proposition to the marketplace. And the ETF, it makes it hard for some institutions, but then that means maybe they would rather buy stocks of companies that are Bitcoin friendly, right? So it's even the negatives are positives. And when the ETFs come, well, maybe my stock's not so unique, but on the other hand, Bitcoin will appreciate by a factor of 10 because there'll be a wall of money coming in the space. So you make it back that way.
All I do is tune out of all of the noise and just look at the network adoption, and then that's it. And over time, as you say, the market cap goes from $1 trillion to 100 trillion, and everything else is noise. How long it takes to get there, kind of irrelevant.
Yeah, I think so.
Michael, brilliant as ever to spend time with you, picking your brains on this stuff. Really fascinating.
Yeah, thanks for your time, Raoul.
Always good. And I'll see you soon.
Hey there, visionaries. Your free membership to Real Vision Crypto, the world's premier source for cryptocurrency and digital asset analysis, is available right now at realvision.com/crypto.